Welcome back. Bidvest has reported flat annual earnings despite a stronger year-on-year performance in the second half. The diversified industrial group says an earnings contraction in the freight and commercial products segments continued in the second half, but the trading profit earned remained a material contributor to the group. Bidvest CEO Mpumi Madisa joins us now for greater perspective. Thank you so much for your time, Mpumi. Now let's actually start off with the improved second half performance. What was the difference from the first half?
Thank you very much, and thanks for the opportunity. Yeah, you're right. I mean, we had a slightly better second half, sitting primarily in two areas. So our bulk terminal operations business, freight, had a slightly better second half performance than they did in the first half. We didn't see a return in those bulk volumes that we spoke about, but we certainly saw a better performance coming out of the balance of the portfolio, and so that helped slightly. And then we had quite a significant turnaround in the Adcock business. If you'll recall, Adcock was down half year about 17%, and they pulled back to being down only 5%. So that was like a material turnaround in those operations. So it's probably sitting primarily in those two areas of the business.
I mean, there were pressure points in certain areas of the business. Some things that jumped out at me were price-sensitive demand and negative price mix. Where are those prevalent?
Yeah, so the price-sensitive demand is really consumer. So we are seeing the consumer under pressure. Disposable income is under pressure. We're seeing it in the automotive business. People are buying less new cars. They're buying more second-hand cars. People are also downgrading by brand. So buying out of more expensive brands into cheaper brands. And people are also holding on to cars longer. So we used to have a replacement cycle that was probably about 5 to 7 years. We're seeing that replacement cycle extending. So the consumer is very, very sensitive. And also in other areas where we provide supply homeware products through retailers, we're also seeing price sensitivity coming through there. So the consumer definitely under pressure.
Yeah.
And then in terms of business mix, that's really just talks to certain parts of the business where we have high margin volumes, and because of the volume contraction, you're seeing a pressure on gross margins, and that's just a function of mix.
And I mean, just talking about the consumer that's under pressure, that really speaks to a more unstable economic environment, and not even just locally, but globally as well. But there are, of course, green shoots and places where you have exceeded, I guess, expectations. Just highlight those green shoots that you have seen.
Sure, there are a number of green shoots, and it's just such a pity that our results don't reflect those areas. So just as a start, our Services South Africa business at a trading profit level is up 14%. That's significant in a South African environment where GDP plus inflation is only 4%. So you can see the outperformance coming through. Our international operations are up 12%, and most of our offshore businesses in hard currency are up significantly. So that's great. And still on the offshore business, we've acquired a business called Citron, which has operations in the UK and North America. This is the first time that Bidvest will have a footprint in Canada and in the US. So we're very excited about that. And then also more locally, two other divisions are up. Branded products is up 8% on the profit line, and our automotive division is also up just under 3%. So really some nice green shoots coming through through the numbers this year.
Yeah. And I mean, just as we're talking about, I guess your experience globally as well, there has been a significant shift in global trade dynamics. Of course, that includes South Africa as well. Is Bidvest seeing that as a threat, or could it present some opportunities?
Yeah, so I mean, the global, I guess, uncertainty and volatility depends on what lens you're looking through that. We're deciding not to take a defensive position. We're taking an offensive position. We're focused on growth. Through this cycle of volatility, we have still made acquisitions. I mean, we made 9 acquisitions in the 12-month period, and overall, over a 24-month period, we've acquired about 20 businesses all over the world, right? So we're still very bullish around the sectors that we have approached. We obviously have overlaid that with a risk management approach. So So from a risk perspective, we've looked at the impact of tariffs. We've looked at the impact of sentiment. We've looked at the impact of low growth, and we've modeled all of that. And one of the big things that we're going to be focusing in the 2026 financial year is bringing down our gross debt levels, increasing the cash generation. I mean, cash generation in this financial year was a highlight. We converted 95% of trading profit to cash. We want to drive that higher in the next financial year, bring down gross debt, bring down cost of debt levels, and deleverage overall. Over a 2-year period, we're wanting to see our leverage reduced down all the way to 1.5 times EBITDA. So we're really focused. And as I said, we're taking an active offensive position rather than being defensive.
Drilling into that acquisition landscape, the results commentary highlights the 2 years of significant M&A activity. What is the pipeline for M&A looking like after that period?
Yeah, our pipeline is now lean. We've been very good over the last 24 months. Our execution rate has been exceptional. We've got very little left in the pipeline. So you're not going to see big acquisitions coming through in the 2026 financial year, maybe 1 or 2. And then when we're back, we need to start rebuilding that pipeline. And that's okay. We've got no issues. It's time for us to integrate those acquisitions. It's time for those acquisitions to start delivering strong organic growth. And as I indicated, start generating cash. What we also obviously want to do is to start seeing our returns start driving up. So specifically from a ROIC perspective, we'd like to start driving up that return profile. And then we start rebuilding in a couple of months or 2 years' time. Once we've got a full pipeline again, we'll execute. I think even outside of acquisitions, one of the things that is exciting for us is our terminal operations. We've just been awarded a 25-year concession in South Africa in our freight business in Richards Bay for a bulk liquid terminal. That's going to require capital. So the reality is that even outside of M&A, even if we're not talking about a full pipeline, we've got CapEx requirements that require cash, specifically into our freight business.
Just lastly, as we wrap up the conversation, Mpumi, you did mention Adcock Ingram, and as we're talking about corporate action, let's actually go into that because we've had Natco Pharma putting out a buyout offer for minority shareholders on Adcock Ingram, and of course, where we could be looking at a delisting of the company. Just talk to me if there are any kind of changes that we could expect in terms of strategy, the growth of Adcock Ingram, with Bidvest still holding the majority shareholding in the company.
Yeah, so we're excited about that. A delisted Adcock is easier for us to manage. A delisted Adcock has less regulatory obligations, so it does become easier. A delisted Adcock with a shareholder who is a large global pharmaceutical provider is also great. Natco have got their own ideas around how they can help us to expand our portfolio in certain areas. So we think that the contribution that they're going to make is going to be great from an earnings perspective. They're specialists. The biggest part of their business is actually in the US. So we're looking forward to their contribution. And then further than that, we also think that there are more synergies that we can extract just between Bidvest and Adcock. And our ability to be able to do that on a more direct basis will be beneficial for both organizations. So we're really excited about this. Natco also has some aspirations on the continent. And so that's a conversation that we have around which areas we expand on the continent through Adcock and which areas, maybe if it is not a part of our strategy, Natco would then expand on their own. But on a net basis, it's going to be good for the organization.
All right. Well, thank you so much for your insights, Mpumi, and for your time. Always appreciate it. That was Mpumi Madisa, CEO of Bidvest.